Good day, everyone. Of course, this market is quite the roller coaster. Lots of volatility, as we've been expecting. And when this market, since QE started in late 2008, when the market comes off very sudden, you'll see that the market tends to remain volatile for a number of weeks. And in 2010 and 2011, when the market fell out of bed, it then retested lows both times. 2010 was a flash crash, and then 2011 was the end of, I think, QE2, and it created a lot of volatility. So I wouldn't be surprised to see the market currently where it's at retest those lows. That would be 42.92 on the NASDAQ. On the S&P, that would be 1867. The volatility model is behaving as it should. As I pointed out the other day, when it had just enormous gains in one day, it's 15% on a 1x and over 30% on a 2x, like UVXY. When you have that kind of gain in a day, it's not a bad idea, especially in this market where gains are hard to come by. To take some profits off the table. I mean, just it's common sense. And that's what I did. I didn't take the whole thing off, and then the next day, of course, it gapped up, and the markets gapped up. So VXX and UVXY, those of course gapped down. But taking profits off the table on a day like that is it'll build profits quite quickly. The model went on a sell signal earlier today. It does believe that on a short-term basis, the market, like I said, is going to perhaps retest. These sell signals generally will last only a few days because the market likes to take the trapdoor down. So if it gets a nice profit in a short amount of time, then it's more likely to move back to cash and take those gains. On I think it was the 1st of September, when the gains were enormous like that, the model contemplated going to cash and just capturing the gains, but the model has had times where the market just starts to fall. Well, it waterfalls, and then the gains can be quite substantial in just 2 or 3 days. So it's a balancing act. And as far as position sizing and maintaining your profit and loss, it's a good idea to take profits off the table when they're that fast. So far, the stocks themselves, there's a lot of volatility, and of course there's going to be some setups, but be mindful of this volatility that we're witnessing. Commodities and oil are trying a bounce here, but I think the problems in China are deeper than they're letting on, and we do have a global recession potentially at hand. So I think markets are worried about that slowdown. And so even though the Fed may have to postpone a rate hike, and certainly the CME futures are indicating that, therefore that would normally be good news for the markets because the markets like QE. And China, of course, said yesterday that they're going to, the ECB rather, said they're going to step up their QE, or they're thinking of stepping it up. And China, of course, is going to manipulate the markets any way they can, and they have a lot of capital to manipulate markets. So my thinking is, if the Chinese step in big time and really try to prop markets, again, it's a band-aid on an infected wound. But all the Federal Reserve banks, central banks have been doing this since the U.S. in 2008. Late 2008, and then some of these other central banks have jumped on the bandwagon. And it would be nice to see a Fed rate hike, so just to kind of start to reverse this trend of manipulation, because as we've noticed, since 2013, the markets are very, very difficult to time, because they just don't develop. The S&P just didn't want to correct more than 5% over the last couple of years. So you don't really get much downside on a sell signal. And meanwhile, when things look like they're about to blow wide open, they don't. The markets find their floor, very shallow floor, and then start to baby step higher again. So this kind of pattern, again, I've never seen anything like it, but then we've never had this kind of outright market manipulation by way of quantitative easing ever in the history of markets. So it's not surprising that we're seeing different kind of patterns that we've never seen before. And then this year, of course, the markets have been sideways and choppy, and it's been, again, that's an impossible market to time. But that said, I was very surprised and pleased to see that the volatility model has done fairly well this year. I mean, quite well, especially given how tough it has been to make money. So again, it's in beta form right now, but I expect that after some time, it's going to turn into a full, the beta will be done. The beta phase will be done. So I guess just sit tight and see how the model unfolds in this environment. With less QE, the model tends to really excel the less QE on the table there is. So that would be, for instance, 2009 to 2012, the model did exceptionally well, even with QE at the helm. But 2013, when more central banks in the Fed and everyone really stepped up and increased the manipulation, that made it very. The model still was profitable, but by an order of magnitude less profitable, shall we say, from 2013 onward. So I'm looking forward to. We might not get a return back to normal markets per se, but a diminishing of the quantitative easing would be a great thing to see. And my expectation is that it will at some point start to diminish because, again, the Fed, the central bank, U.S. central bank, is indicating that it really does. It's time to raise rates. The unemployment rate's now at 5.1%. That's the lowest it's been since this whole thing began in 2008. And wage pressures are higher. The things that they look at are looking better and better. So I think the Fed is mindful of all that, and I think we're going to see a rate hike hopefully by the end of this year. And China's going to do what it's going to do, but I don't think the Fed is going to be so guided by China. I think they're going to really be more guided by their economic data. And of course, whether you want to believe the economic data is a whole different argument as well. But for the sake of argument, they're going to focus on their numbers, whether they're skewed or not, different argument. So I think the Fed is going to be pressured. They're going to have no choice but to do a rate hike, probably by early next year. And the Fed futures, the CME futures do indicate that there's a very high chance of rate hike by early next year. So yeah, let's hope for a return to some sense of normalcy in these markets. And with that, I'll hand it over to Gil.
Well, I would say normal or not, if you're smart and you're nimble and you can see what's happening right in front of you in terms of what the stocks are doing, I think it's quite possible to make money. And if you've been shorting over the last month, which is something we've been discussing in these webinars repeatedly, you've been making some decent money. So, and that's really the bottom line. So where we're at right now, I think is pretty normal, the action that you're seeing, given the washout selling that we saw in the NASDAQ 2 Mondays ago. So, and I pointed out the similarity to, let me pull these up, similarity to 2010. So we go back to, here's 2010, sliding along. This is one thing I like about HGSI. Those of you using MarketSmith, you can't do this, so, which I think is kind of silly, but you pay a lot less for this and you actually get a lot more than you get on MarketSmith, to tell you the truth. That's my view. In any case, you have the break here, so here's similar break, and the circumstances are similar in that it's this sort of panicky, some say machine-driven break to the downside. And of course, there was investigations of that at the time, and now people are, looking at today's situation and this break and whether there was some hanky-panky going on. And I'm sure when you have that many sellers, I'm sure somebody can work it. And why not? If they have an incentive to and the system allows them to, why wouldn't they? So they take you down low and turn it back around. And if you're smart, I actually covered all my shorts on Friday. I was actually able to work a little bit in here on the short side before the market started to turn. But I actually covered here, and frankly, having started shorting back here in late July, that was very nice. And in this kind of market, it's hard to tell whether you're going to get something like this again. It was surprising that we did. But it tells you how weak we are, because relative to 2010, back then we broke down through the 50-day line and bounced off the 200-day line and then rallied back to the 50-day line where we failed at the line. And also you can see the 10-day and the 20-day are all crossing lower. In this case, we are well below the 50-day, and on this break, we were well below the 200-day. Now we're trying to rally back up. My thinking is you could see the market rally all the way back up to the 200-day line in a choppy sort of thing. That's just a big consolidation. It's not clear to me whether this is a short-term washout and whether necessarily we're going to follow the exact same pattern. You can see there's some similarities, but it's not a roadmap by any stretch of the imagination. Maybe you retest these lows, you either undercut them like you did here, but back in 2010 you undercut these lows and it did lead to some rallies, but those were shortable rallies. And then you gap down to new lows. It was the end of the world at that point, but that was the low. And then we set up again. The market came out and turned around. We had a follow-through day, and we broke out to new highs. So, you know, this could break down and retest. It could go through the lows. We could be in the throes of the worst bear market since, you know, 2000 or 2008 or whatever. We don't know. Nobody knows for sure. And of course, you hear on financial TV and in the media, everybody's trying to tell you the market looks like this year or that year or this year or that year. But while it looks like 2010, you can't rely on that as a roadmap for precisely how this is going to play out. So I think there are certain underlying conditions that are different. Wasn't that the 2010 crash, flash crash, Dr. K, wasn't that because of things going on in Europe at the time with Greece?
It was starting to percolate. Yeah, I mean there was always, you know, that wall of worry that seems to be
Wasn't there
intact.
an event that triggered it? Because I remember that you had a break here. There's some news about Greece, and then the next day they announced that they had some financing or something, and it rallied for a day or two, and then boom, then it blew wide open. And I'm trying to remember if that was what it was. But in any case, I think the backdrop is a little different today. And the other thing, the weird wild card here is whether the Chinese government now decides to get into heavy-duty money printing, the way that the Fed and the ECB have. The other day, Mario Draghi was on TV after the ECB meeting talking about how they're going to continue with their easy money policy. The euro plummeted, dollar rallied. And so that's all just continuing. And so behind that, now you're going to have another wave coming from China. What does that do in terms of creating volatility in the markets? And does the market really respond to it? So, you know, you can get wrapped up in all of that. But I think the bottom line is that you can't use this necessarily as a model or a roadmap for what it's going to do from here, what the market's going to do. It could do this sort of action, or it could do something like, I think in the break off of 2007, yeah, here's the break off of 2007 here. Market topped in late October, and we broke off the peak, and we came down about 11% or so, I think similar to what happened here. And then we just kind of tracked sideways. See that? And it looked like you were going to come out of it, and then you did, and you finally failed. So, you know, we could do something like that. So it's really not clear what's going on in terms of how this will play out. All you can do is watch the stock. So if you come in short, I'll run through my short list here. Apple's coming down, but you see here, you're kind of bumping against the 20-day moving average, and maybe you're going to break down, maybe you're just going to chop back and forth. And Mobileye, same thing, shortable at the 50-day, but coming in and testing these lows. Netflix looks like a head and shoulders. Fractal head and shoulders after this big run, so you can even see it on the weekly chart. Tesla rolling back. Facebook rolling off the 50-day and the 20-day. Twitter is trying to rally, but it's way down there. Starbucks finding resistance. It looks like Facebook to some extent at the 50-day and the 20-day. Now you're going to get a sense as I go through these. Basically, you got stocks have broken down in almost every case, and they made kind of a panic low, and now they're rallying into potential resistance. So everything looks like this. So it's hard for me to tell right now whether you're looking at, let's look at another one. Here you go. You break down, bounce off the 200-day, up into the neckline of what is now a fractal head and shoulders and the 20-day. So it becomes shortable there, but whether it's going to bust or just track sideways and give you all these, I guess you would call tactical short sale opportunities, and you're just shorting it back and forth until you finally get the big break. Maybe that's what happens. Here's Intel coming up to the 50-day. BMW, which looks pretty weak, rallying up into this point of potential resistance around the 10-day, the 20-day. CRM, Salesforce was a short actually coming up here on earnings, and now it's rolling back. Notice how you got resistance here at the 20-day and you're coming down. Maybe you just come down and you bounce. Same thing with data, which was a short in here, and you could have gotten this move, and now you can be hitting it on the rallies up to the 200-day, and it comes down a little bit to the lows of the range, but that's kind of where you are. Are you getting a sense of what I'm talking about here? You're basically seeing these stocks moving within ranges, so they become shortable at the top of the range right now, and then they'll bounce back up. So they get everybody excited that they're going to break down again, and they rally. So, Splunk was a good one to short the other day at the 200-day, and you had a nice break. Retests this low, and then it bounces in the 10-day and reverses. So for all you know, this thing's going to go back and forth for a period of time, and it might make sense given that we had this huge break, and it gets back to this idea that I've talked about many times about how many times is Cinderella going to come to the ball. If she just showed up, it's going to take Prince Charming a while to find her again, so it's not like she's going to come back right away. So my thinking is you may need to put in a little more time going sideways, and it's going to be choppy, and you will get tactical, intraday or day trading or even 1 or 2 day short sale trades like you see here with Splunk, for example. But that's all you're going to get in the short term. And my approach would be to just work it that way, because hopefully I can get short when you see a break start to occur. Usually that'll occur on a reversal day. Maybe yesterday was that day. I don't know. We'll see. Workday is related to Splunk. Here you have the breakdown. Rally into the 10-day line and now breaking down, but it's testing these lows. Is it going to bust? Hard to say. NXPI, same situation here, broke down, and this is actually shortable up here. I think we talked about it up right in here along the 50-day when it started to break, and shortable up in here. Now you've broken down very hard. You see on the weekly chart, you see the head and shoulders. You're coming back to the neckline, but maybe it bumps up in here for a couple, 3 more weeks. That's a possibility. And you notice it's holding up today and acts kind of like it's trying to set up to move higher. And some of these look this way. So I think you really have to take you have to take each one with this, in terms of the overall context of the chart, and take them more as short-term trades for now, because that looks like what you're headed for. Somebody making a point here. MarketSmith allows users to look at historical price charts. I haven't seen the ability to look at historical stock charts, but I'll have to check that, so maybe I'm wrong on that. In any case, I much prefer the scrolling ability that HGSI offers rather than having to type in a date. Here's a Vago. You can see here's a left shoulder head, possibly right shoulder forming. So again, here you're bouncing off the 200-day, running into resistance at the 50-day, chopping sideways. Skyworks doing the same thing. And so again, these become probably shortable near the highs of the ranges, and you might be able to pick off some day trades and maybe try to build a cushion so that you're in position to maybe hold some small shorts. And I might hold 30% short overnight just to catch a big break if I think we're at a point where we might break. But sometimes that's just a matter of being lucky and not necessarily anything that one can insert values into a formula and come up with an answer as to how short they should be overnight. It's really a matter of judgment, your profit cushion at that time. So if you made a ton of money over the last month on the short side, you can afford to take a hit of 2 or 3% maybe on a gap up. So think in those terms, really. So a lot of people will ask me, well, are you short overnight? And I think that's a stupid question, because what does it matter whether I'm short or not? Do you remember Bill O'Neill, Chris? I don't know if he ever told you. He would always say to me, don't worry about what everybody else is doing. Worry about what you're doing. And I always find it interesting that people are curious. They want to know, what are your positions? What are you doing? If you saw the way I traded, you probably wouldn't understand what I'm doing. You think I was nuts, probably.
Yeah, no, it's just a natural tendency. I mean, I remember, as part of my learning was in 1996 with Dan Morris. I thought he was the wonder kid. He had a great track record, and We would talk about stocks into the night sometimes, and he would talk about a position he has on, and I would always track it afterwards. I would always see like, oh, how did the position do,
Uh-huh.
And it shouldn't matter though. It's like it's like a waste of time actually to even bother with. Who cares? Who cares? He's a market wizard, great. But why am I tracking his position?
Right.
His trading style is completely different from mine. It was, and I'm sure it probably still is.
Right.
And I learned very quickly, like, yeah, it's nonsense. It is absolute nonsense to do that because his time frames are different, his position sizing different, etc. So that was a good learning experience for me, because then it just doesn't matter. I don't care what someone else is doing. It's totally irrelevant, and investors really need to let go of that desire to know what someone is doing. And it's also going to screw up your trading because I remember Dan was he was very negative on a stock and I wasn't, but it affected my position size. I went in with half a position instead of a full position just because he didn't like the thing. But he didn't like it on a short-term basis, whereas my basis was more intermediate term, and the position turned out to be quite profitable. So that, again, that was also a learning experience. Don't get influenced by what someone else says about a stock.
Agreed. I think in fact, I know this, when you and I were both there, we never told each other what we were doing. We never asked each other what we were doing. But when we did our post-mortems, which we sometimes did together, we would notice that we were actually trading the same stocks, but we may have been trading them completely differently. So, what
Right.
I'm doing, what Dr. K is doing is kind of irrelevant to the process. The idea is understanding the process as you approach it and building a method around your own psychology and how you want to handle it. So, some people like to go 400% short, some don't. There was a time when I'd go hold 150% short overnight. I was on the day of 9/11. I was short that morning and heavy short, which is a weird feeling, I remember, because you're watching what's happening on TV. And I remember that was like 5:30 in the morning our time here on the West Coast in California, and looking up at the CNBC screen in my office and seeing that first plane, the hole it made, and then you see the futures just tanking, and you're 150% short. So you're not sure whether to be happy or terrified. So, but in these markets, I think you have to work it a little bit differently because you're subject to this sort of guess the gap sort of baloney, where you'll see these random gaps, and you've seen them the last few days, just huge gap moves, huge moves up, huge moves down. Everything's all over the place. And so I tend not to hold so much overnight, and I try to work things coming in and out of them. So like, for example, coming short Mobileye, short it here, cover at the close, the next day short it again, it breaks, cover it down here, short it again here, and just kind of work it back and forth, maybe holding a little tiny bit overnight. So, but, I'm always interested to find out the people when they want to ask me whether I'm short overnight or not. They never ask me how much, which tells me they don't have a clue what they're asking in the first place. So anyways, somebody says, here, Dr. K, you'll like this. Congrats, Dr. K, congrats on the new volatility model. It's looking good as you've been abused with the MDM over the last couple of years. Or is this yours and Gil's model since it's working? I'll just say I have nothing. I don't use models. I don't think models are necessary to make big money in the market. That's my opinion. So no, of course it's not mine. If it's working, it's all Dr. K's work. So he can take all the credit for it. So
I love the cheekiness of the question. That's great. That's made me laugh. Yeah, no, the timing model, the market direction model, is something that I was inspired by O'Neill's the M in Cancelim, back in 1989. And I just thought the whole thing was arbitrary. I didn't make heads or tails of any of this, what I called nonsense, until 1991 when I had my first big, good winning year in the market. And that was due in large part to being in the right stocks at the right time. And so I started to formalize a set of rules based on what Bill O'Neill talked about in his very famous How to Make Money in Stocks book. Because I noticed when I came to the company in 1996, January 1996, I noticed that it seemed a lot of the rules that they were putting into timing the market were arbitrary. So I'd already done a statistical workup, but it really accelerated my work in the market direction model, which at the time wasn't called that. It just was my way of timing the market, and it helped in volumes over the years. But the market direction model market timing doesn't function very well when the markets are being manipulated heavily, like we saw 2013, even 2012 was a tough year. The model did well prior to that, even with QE, because it accounted for QE. But when you get these shallow floors, artificial floors, it's very, very difficult to make much headway. And so I would love to see the central banks back off QE, take their foot off the accelerator. That would be great, because then the model is based on human nature, and so obviously it hasn't just worked since the 1990s. I mean, I've spot tested it in going all the way back to the early 20th century, and it's always worked. In fact, it worked very well in 1920s, 1930s. And so, I'm looking forward to a cleaner time. One thing we know is that the only thing that doesn't change is change. So this QE manipulation is not going to remain a permanent fixture of the markets. It's just a question of when it changes. And it's good news that the Fed is really getting close now to the point of doing a rate hike. That'll be a nice breather. But what was nicely surprising to me, though, was this volatility model. It was originally the UVXY, but that instrument, to really trade on that, there's too much risk involved. Even by my book, it's too volatile. Some of you may remember the model was up over 550% over a string of signals in 2011. Those were all documented in real time. The problem was that with those kinds of crazy gains, you can have some crazy losses. And then the model also suffered. I think it lost something like 60% of its value. It had more than a 2/3 drawdown or something. It's pretty hectic. So those are drawdowns that I don't want to have to deal with, and I don't think most people would like a 66% drawdown in their accounts. So I can tolerate 50%. I've had 50% drawdowns, and those don't bother me. But there's actually quite a difference between 66% and 50%. With 66%, you've got to run your account up 200% to get back to break even. Whereas if you are down 50%, you only have to double your account to break back even. This particular volatility model, yes, it's possible. It has not had a 50% drawdown. That said, it's possible it could, but I'm okay with that, because again, the model can make up. It's been known to more than double in a matter of months. So even if we did have that kind of a 50% downside, the model tends to make it up pretty quickly. And overall, over time, it tends to do really well in non-manipulated markets. So that would be prior to 2009, because QE really didn't get going until 2009. So prior to 2009, the returns are, I don't like to talk about the returns because I don't want people to think, oh, this is, we can put on more and more investment and overweight their positions. So I don't like to talk about, let's just say the model is very successful prior to 2009, and that's an understatement. 2009 to 2012, it's done very well. 2013 onward, the returns are far less because of all the rampant manipulation going on. But that said, I mean, in a year like this year where markets are sideways and choppy, I'm very pleased to see that in real time my own money has done decently. And I didn't take all the signals. Had I taken all the signals, I would have done even better. So that's why I felt, now is the time that let's try a beta with this model. But again, keep your position sizes in, always keep in respect and to your risk tolerance levels, because these instruments can be very volatile, as we saw the other day. They can swing 15 to 30% in a day, but they can also lose, 10 to 20% in a day as well. So I thought that was a good experience for everyone to have the other day, because it really it draws a very clear line on position sizing technique and your risk tolerance levels.
Does that mean you're done?
I am done. Actually, the market's
Okay.
not done. Or maybe the market is done, actually. Looks like the S&P is wanting to retest lows here, which is good because we're on a sell signal here.
All right. Somebody says, can you move your window so we can see the names of the stocks being plotted? I don't know. I think you can see them here. There's the symbols right smack in the middle here. So, and up here, I showed Chris. Do you see you can see the label up here on the left side, right? Or
I can see,
the
yeah, everything looks
yeah.
fine.
So that's up there on the chart. So maybe it's your cheap little computer screen. Who knows? Anyways, somebody says, let's see. Well, you know what? Let me get through my short list. This is my short list we've been looking at, okay? And I'll come in and look at these names, and if some start rallying intraday, like I'm seeing PNW, LinkedIn, etc., data rallying intraday, I may come out from on the short side if they're coming up into areas of overhead resistance. So you look at this Cuervo, and you get a rally up towards the 20-day. I would like to see maybe 60, but again, you get this sense of how it already broke down, and it had already had its huge break before you had the mini flash crash or whatever the heck they're calling it now. But you can see it's just chopping sideways, and so you short it up here and you cover down here, you short up here, you cover down here, and you're just day trading it mostly. So this is what the short side looks like from a practical perspective following last Monday's crash day or panic selling day or capitulation selling day. And all I've been doing is bopping these things on the shorts. I've been able to make some progress, small but steady, and just working it that way. And I did cover shorts this morning near the open based on the big gap down. So in the break that we saw, now it's kind of starting to roll over again. Some of these stocks that rally intraday give you a shot to put them out. F5 we talked about I think last week, or we talked about on the rally, and then this move back below the 200-day. And you can see how you could be shorted. You break here, it could be shorted at the 50-day, it comes down, you cover, you short again at the 200-day, and it's just chopping back and forth. So the question really is for any of these names is whether we're on the verge of a break, a deeper break back towards the lows of 2 Mondays ago. And that's really the critical question to be answered right now. So Red Hat, that's another one. You can see the break and you rally back to the 10-day, boom. And you notice how you'll see some of them rally up to the 10-day, some to the 20-day, some to the 50-day. Sometimes if you put a 65-day exponential, you can use that as well. But you can short them at those moving averages, but you're using very tight stops. And I'll come in and usually short a little bit, maybe 15 to 20%, and see if that starts to work. And if it feels weak to me, and I generally operate on a viscerally, where I'm feeling things as I'm going along. I'm watching how things trade and seeing whether I'm sensing whether there's more selling or buying pressure, watching the tape, which isn't really a tape anymore. Watching all dust blinking lights, as I like to call it. I remember back when I worked in Silicon Valley, they used to joke about the computer screen being alluring because of all dust blinking lights, which I guess they're trying to imitate a German speaker, native speaker of German. And some guy had that paste up as well, but I thought it was pretty funny, and it's more relevant these days because when you look at your quote screen, talk about blinking lights, they're all over the place. But anyways, that's all I'm doing these days. Tape watching is no longer tape watching or tape reading. It's called watching dust blinking lights. So let's see, continuing down the list. You see, same thing with Biogen, same thing with Gilead, Baidu, same thing, Illumina, same thing, Google, same thing. And again, shortable, you get the break, bounces off the 50-day or roughly around it, and then back up in here. Definitely, if I had shorted this thing, say here on the break of the 10-day, and I'm shorted here, I definitely would be covering on that sort of break. I might even be covering on this because you're undercutting this low. Either way, you can re-short again near the 10-day, 20-day, and it skids just a little bit past, and now it's coming down. Whether that means it's going to bust wide open and head for the 200-day, still an open question. But if that's what happens, you got to be in position to get lucky. So Amazon, same thing, and rallies to the underside of this flag, and that's where it's hitting resistance, now rolling back. Notice how it's hanging along the 50-day. If it busts the 50-day, then of course probably you could short it using the 50-day as your upside stop and looking for an undercut of this low that takes you to the 20-day. So, you know, those are scenarios that you're looking for. And I think in most of these situations, you're looking at that key low of 2 Mondays ago as some sort of reference low that you're going to either retest or undercut, and you want to see how that plays out. Whether that, if it does happen, obviously you're going to have a short sale opportunity, but you have to be trying to put them out up in here as they rally into resistance, like Starbucks is doing here, which looks like Facebook. When these are old shorts, you can even see from the weekly chart, this thing's been coming down. There's a nice head and shoulders breaking down. Citrix, somebody mentioned this one to me the other day, and that's actually a decent example. It hasn't had a big move, though. If you look at this, it's basically gone sideways for a long period of time, and then it tried to break out and failed. So, you know, I guess you could try and short it on these rallies up into, I don't know, this area of congestion. But to me, it's a little less clear because it wasn't a big leader. Taser, you can see, is forming a big ugly head and shoulders. It seems to imply that it needs to rally towards the 10-week line here. Notice how you're hanging out along the 20-day line on the daily chart. And you would think you're going to rally, you know, to form a right shoulder. The 10-week line is crossing below the 40-week line. That's a black cross. And I wouldn't make too much of that. Watch the action itself. If you do get a rally back up into the 10 or the 40-week lines here, that might be shortable. So, but at this point, you know, if you had shorted the stock sooner, you're undercutting this low here. And yeah, you can undercut it by a good 10% or more. And, you know, that is still an undercut that triggers a rally. So, but a lot of this movement 2 Mondays ago, that was exaggerated. I mean, you look at a lot of the charts, and they all have these big streaks to the downside where they close well off the lows. And I think a lot of the prices down here were phony or very instantaneous. They weren't there very long, in other words. And I've heard a lot of stories about people trying to cover shorts and getting crummy fills, or trying to go long getting crummy fills and whatnot. So let's see. If we go into a global recession / depression, how can the Fed raise rates? Well, they can't, but they still can't. They never will be able to. We're going to have perpetually 0% interest rates like Japan has for the last 30 years or whatever. In the past, roughly what percentage of time has the volatility model tended to be on a buyer-sell signal as opposed to cash? So in other words, Dr. K, what percentage of the time has the VIX model been on either a buyer or a sell signal versus what percentage of the time it's been in cash?
Okay, well, that's a good question.
Okay.
I first thought it was when I heard it the second time. Yeah, no, that's a good question. It's the buy signals, as we know, the market tends to take the stairs up, so it looks for uptrends, and on a good uptrend, it's going to stay with it, and it could stay with it for weeks on a buy signal. A sell signal, as I've said, the market takes a trapdoor down, especially in this QE manipulated environment. So sell signals tend to last just a few days, maybe even less than that. And as far as the cash positions, the model doesn't really like cash so much, but it will be in cash from time to time. But it's looking for short-term moves. So I suppose it would have the longest cash position if the market were not trending higher and yet volatility was suppressed, if that makes sense. In other words, when the market is trending higher, yes, volatility is low, but we're in an uptrend, so it should be on a buy signal. But if the market is not uptrending and the volatility is low, then the model's more likely to, there's nothing to do then. And that's a very unusual period. I mean, especially going back many, many years, it's unusual for the market to be not in an uptrend and for volatility to be suppressed. So I would say expect the model, and of course based in real-time testing, the model's not in cash very often. And if it is, it's probably going to be in cash for just a few days. But definitely not, it's never been in cash for, say, a number of weeks. It's just never happened.
Okay, let's see. Here's another question. This is actually a typical newbie question. And when I talk about a newbie question, someone who's not that sophisticated, or at least doesn't come across that way, because they ask a question that's kind of intuitively silly, but and that's okay. I mean, if you're new to investing, expect to ask a lot of stupid questions. That's how you learn to some extent. Of course, if you do it here, expect me to beat you up, but you know that comes with territory, as most people know. But in any case, here's the question. This one's this one's for you. I'll let you answer it, because to me it's like it's anyways. Here it is. What are the best short ETFs for trading in IRAs? I'm trying not to laugh. How about the ones that only go up? That's it.
You can't short. I see what. So you can buy. Yeah, you want to be able to short in your IRA, which you can, but you want to be able to buy inverse ETFs. So if the market goes down, you'll buy these and you'll make money. And so yeah, I mean, if it all depends on your risk tolerance levels. I mean, you know, they've got 1x, 2x, 3x ETFs that mimic, you know, the NASDAQ, the S&P, the Dow, and these all have different volatility characteristics. The NASDAQ tends to be the most volatile, S&P less so, but there's such a wide universe of these things. You know, of course, there's Russell 2000 ETFs as well, and I believe there's 1x, 2x, and 3x ETFs for each of these major indices. Well, there definitely is. So understand the volatility, understand the risks, and then you will know which short ETF is appropriate for your trading style. I mean, as a general, you'll notice that in our reports on the market direction model, we tend to suggest S&P ETFs on the long or short side, NASDAQ ETFs long or short side, and sometimes we step out of that realm, but you know, those are sort of the benchmark indices, and so we use the respective ETFs.
So, what are the best ones for IRAs?
Well, it comes down to your risk tolerance level.
What are the
completely
best ones,
risk tolerance level.
What are the best ones for 401k?
I mean, it's like, and also it's funny because like my IRA, you know, I whip that all over the place, but
right,
you know,
not everybody's going to do that, you know. So it's not a matter of whether it's an IRA or a margin account or a cash account or you know your grandma's account. It's a matter of the individual's risk tolerance for that specific account. Not that it's an IRA. I don't, you know, you hear a lot of people talk about, you know, do you believe, like someone emailed me, do you believe in using dividend stocks to generate income for retirement? What? No, I believe in generating massive capital gains for retirement. How's that? But, you know, you get a lot of people have these ideas about investing I think are silly, and I think like dividends are one of them. The idea that a IRA is treated any differently than a regular account is silly too, because it all should be based on your own risk tolerance and your ability to leverage. You can't leverage an IRA account, so obviously anything you do is going to be done on a cash basis, and that's something that has to be taken into account in your approach. So you know, there isn't anything that's necessarily better for an IRA than it is for a margin account. You know, my view, the best thing for any account is the thing that's going to produce the most profits in the shortest amount of time. So, you know, that's the best one. There is no specific label you can stamp on some ETF that says this is approved for IRAs, you know. It's like that commercial, that gold commercial, you know, invest now in a gold-backed IRA. What the hell does that mean? Gold-backed IRA? Does that mean somehow the value never goes down? No, what it means it's invested in gold, which is an extremely volatile commodity. So you wonder, you know, they're trying to portray this image of something stable and steady in your IRA, a gold-backed IRA, when in fact you're subjecting yourself to a huge amount of volatility, I think. So, you know, there's a lot of this silliness out there. So I think the questions, this is good too. Why do you use the L version of Google? Because I like more letters. They look better. It looks more like the name. All I have to do is add an E and I have the whole name. So you can use either one, but I think Google is more liquid. Let's see, blah, blah, blah. Somebody says, love that tough love. Is there any good reference on risk management in relation to market and VIX? What?
Say that again. Can you ask that one more time?
Is there any good reference, I'm assuming a book or something you can read, on risk management in relationship to market and VIX? I read your folks' books and get some qualitative treatment, but want to look further. I don't know, you're looking for some sort of quant analysis, I guess. You're talking to the wrong guy here. Maybe, Dr. K, you have an answer.
You know, I don't have any books off the top of my head. Not for that. You could Google, you know, some keywords, and you'll find probably what you're looking for.
Or you could try some common sense, which is that if the VIX model is extremely volatile and you can see the range of performance it can give you, big upside moves versus big downside moves, then you would scale, position size it and scale it according to your own risk tolerance. So I don't really see anything that's there's some sort of magical risk management that you're going to calculate some percentage of your portfolio that should be invested in the VIX model. I think it's all your own personal preference, wouldn't you say, Dr. K?
Well, yeah, I mean, if the question is understanding the VIX model in relation to the markets, and you know, and it has nothing to do with my model. In other words, it just has to do with the VIX. If you want to understand the VIX and the way it works in relation to markets, you know, that's Google. They have lots of books on that sort of thing. Or you can just don't even have to buy the book. Just go online. There's lots of free information out there that will answer your question on how the VIX works. And in terms of my model, yeah, it is a VIX volatility model, but the name of it is a little bit of a misnomer. I mean, yeah, the VIX is involved, but it's not it's not the you know, the end all be all of the model. There's a lot of different components going on. You know, so you know, just because you understand the VIX and the volatility of the VIX as an instrument doesn't mean you're going to understand the volatility of the model. The model is the model, and obviously the VIX can be very volatile, but the instruments that you use to invest, such as the UVXY or the TVIX or the VXX, XIV, any of those things, understand the risk involved in putting a position on. In other words, study those instruments and study the volatility inherent in those, and then you know, you can position size accordingly. And you'll know, as I've said, I think I've said it a few times now, and in the newsletters, the reports, this stuff, these instruments can whip all over the place very quickly. So make sure you are aware of that.
Let's see, we got one comment. Thanks for the tough love and slapping me around from time to time. You're welcome, Scotty. It was fun, but you've graduated apparently beyond that, because Scotty, who I won't go into any detail about him, but he used to ask a lot of stupid questions, like really stupid questions, and I used to beat him silly or senseless over it. And I've had dinner with him, and so I know him pretty well now. And but you know, he's come a long way, and he's a lot smarter, so he doesn't really ask any stupid questions. So all that's to say, we need some of you out there who are new to kind of fill in with some stupid questions. You know, let's see how brave you are. So I don't know. I used to watch Bill O'Neill beat people up pretty good if he thought something dumb was being uttered. You know, first you get the big whooshing sound. He'd look in and go, you know, like that, and then, you know, oh, here it comes. And I can remember him saying to someone, "What, are you stupid?" You know, it's in front of a whole group of people. So I don't know. I think I'm nicer than Bill was. And Dr. K, of course, just wouldn't lift a finger against anybody. He's too nice. But anyways, somebody writes, I have had to explain to some people how fixed income securities price moves can be more volatile than stock prices. They can. If anybody remembers, I think it was a 94 bond crash in February of 94, bond markets got hammered. I remember at the time there was this whole theme. I was at Merrill Lynch at the time, and you probably remember as well, Gar, because you were there around the same time I was, at Merrill Lynch in Beverly Hills. It was very popular to talk about this theme of the hunt for yield. You know, people were looking for yield. The Fed was starting what has now become an historic lowering of interest rates over the last 20 years, I would say, and or so, and sort of a secular decline in interest rates. And so people were looking for things that were yielding better returns. And so you had all these leveraged bond funds that showed up. A short-term bond fund, which would basically borrow short-term and pay short-term interest rates, and then turn around and invest in long-term securities. So basically what you're doing is, say, buying or selling a short-term debt at 3 or 4%, borrowing money essentially at those rates, and then turning around and buy a longer-dated bond. So, you know, go from, say, a 3-year piece of paper that you're paying interest on to using the funds from that to buy a longer term piece of paper yielding, say, 6%. So they were playing that spread, and there was a lot of that going on at the time. And then when the Fed started raising rates in February of '94, the bond market crashed, and a lot of these things came undone. I remember even Payne Weber, where I was working at, they had to settle with a bunch of clients because the fund didn't produce safe income like it was advertised to, or something like that. Anyways, Scotty says the stupid questions come from years of learning the wrong stuff and listening to the wrong people. I suppose so. Gar, I won't repeat what you just wrote. But yeah, you're right. Thank you, Chris, for sharing that you used to obsess about what positions your mentors or guides were holding. It's somehow reassuring to know that these were things you worked through as you grew as a trader. Yeah.
Yeah, we weren't born overnight. I mean, it's a it's a nice long process of learning and evolving, just like life. That's why trading is life, life is trading. As we called our last chapter in our first book, and that makes it fun and fascinating because you can see your progress.
I don't know. Some might argue that life is life and trading is trading, but I'm more of an existentialist.
My dad would say that, I think.
Anyways, I don't really have anything to add. You can kind of get a sense of what I'm looking at here. I got my short list here, which I've let you guys all see. And I rotate around this. As you can see, some of these names are starting to rally. So if you covered them earlier, that was probably the smart thing to do. And if you came in short anything, I did, and I did cover. Now I'm watching how this rally pans out. But on the indexes, it looks pretty grim because you're just kind of triangulating in here. You got this sort of, I guess you call it an apex or something like that, a pennant, and maybe you're just going to tighten up in here and then break back to the downside. So it might be something to watch for, or we just close at the lows today and head lower by the close. We do have a 3-day weekend. China reopens on Sunday night our time, and anything could happen. So I think you're in a dangerous environment for the long side. You shouldn't even be long as far as I'm concerned, unless you're trading something on a oversold balance, which is always a possibility. I mean, those who were alert to that a couple of Mondays ago, and I talked to a couple of people who were very fast traders who covered shorts and then went long a couple of things. They got some nice bounces. If you'd picked off Apple anywhere in the mid 90s, you've done pretty well rather. And so that's really all there is on the long side. On the short side, we can see how things are after breaking and producing a situation, even with Intel, where if you were shorting, you would use the crush of liquidity, and this is something I talk about repeatedly in the new book on short selling. You use a crush of liquidity to cover your positions, not get a big, and get all greedy, thinking that now you're going to go buy a small island with your short sale profits. You look to use those big breaks and those panic lows to cover into very easily, and then set up again on the rally. So that's where we're at right now. Now, you don't know exactly where the rally gives way. It could give way sooner, it could give way later, but you take your tactical shots as you can, because even if we go back to, let's go back to 2007. Okay, so we go all the way back. Zoom. Here we go. Here we go. You could do this, see, and you can see how you get these. You get a break, and then you rally, and then you get a tactical short sale opportunity here. Okay, as you break to the bottom of the range, and then you rally back up to the top, and another short sale opportunity. This time you blow wide open, and that occurred back in January, and you had a nice break at that point. And let's see if we can show this. Yeah, that was actually pretty brutal at that time. Whew. Wow. But where did this thing find support? It's like this thing just went into free fall. Looks like down on top of this structure here. Look at that, way down there. But you see how that played out? You get your first break. No, actually, this undercut here. You formed a low, you undercut it, and then you went sideways again. So you see how you can get these periods of back and forth action. So maybe that's how we play out. Anyways, so that's all I have, you guys. That's basically where we're at. So we'll just see how this goes. And everyone have a good weekend, and we'll catch you next week.
So long, everyone.